Broadcom just reported the best quarter in its history. Record revenue of $22.2 billion. AI chip revenue up 143%. Free cash flow over $10 billion in a single quarter for the first time. The stock opened 15% lower. That price action, a 15% decline on a record quarter, is not a story about Broadcom. It is a story about the entire AI trade. The market has moved to a place where perfection is the minimum requirement, and 99% is not enough. Welcome to Market Lens. I am Daniel Reed. The June 3 earnings aftermath is in full effect. Every company that reported delivered positive results. Almost everyone got sold. The margin for error has collapsed to zero. Let's start with Broadcom. AVGO opened at roughly 410, down 15% from yesterday's close near 482. That is a $270 billion market cap loss at the low, more than the entire market cap of AMD. The trigger was guidance, not the quarter. Broadcom guided Q3 AI chip revenue to $16 billion. Analysts wanted $17.2. That $1.2 billion gap was the difference between a stock that held and a stock that collapsed. The full-year AI target of $100 billion for fiscal 2027 was held unchanged. Bulls wanted it raised. The sell-off spread across the entire semiconductor complex. Micron fell 7%, Supermicro 7%, AMD and Qualcomm 4% each. Even Nvidia dropped nearly 1%. The message: the AI trade has moved from show me the growth to show me more than I already priced in. At 94 times earnings, perfection is the baseline. Broadcom delivered 99%. The market wanted 100. Bernstein raised their target to 550 this morning. B of A raised to 530. Both see the drop as a recalibration, not a verdict. But the entire AI complex needs to decompress from valuations that ran too far, too fast. CrowdStrike followed the same pattern. Revenue of $1.39 billion, beating estimates. EPS of 1.10, beating by 3%. Record net new ARR of $256 million. A 4-for-1 stock split. Full-year guidance raised across every metric. The stock opened down 10%. The issue is identical. The stock had rallied 60% year-to-date into the print. When the run-up already prices in a beat, the beat becomes a sell the news event. CrowdStrike guided Q2 in line. In a normal market, that is fine. In a market where the stock has tripled from its 2024 lows, in line is a disappointment. Bernstein raised to 413. Goldman raised to 726. The long thesis is intact, but OPEX rose 15% from AI investment spending, and the market is now asking margin questions it was not asking 4 weeks ago. CrowdStrike needs to establish a new base before buyers return. PVH, parent of Tommy Hilfiger and Calvin Klein, was the worst casualty of the regular session. The stock opened down 20%. PVH reported a first-quarter earnings beat, revenue in line, but the company reiterated full-year guidance rather than raising it. In a market rotating out of consumer discretionary, with oil at 98 and tariffs expanding, reiterating is a sign of caution. The market treated it as a warning and cut 20% of the company's value in a single session. PVH is the cleanest example of what happens when the bar has moved and you only meet it. Lululemon reported after the close, and the reaction was brutal, down 10% after hours. On the surface, the quarter looked fine. Revenue of $2.47 billion beat the $2.43 billion consensus. EPS of 1.69 edged past 1.68. China revenue grew 30%, a beat by any measure. But Lululemon slashed full-year guidance. Fiscal 2026 revenue cut to $11.15 billion, down from $11.35 to $11.5. Full-year EPS cut to $10.95 to $11.15, down from $12.10 to $12.30. Over $1 wiped out. Q2 guidance was even weaker. Revenue $2.45 to $2.48 billion against $2.6 expected. Q2 EPS $1.76 to $1.81 against $2.68 expected. North America comparable sales fell 6%. Gross margin contracted 410 basis points. Tariffs alone took 280 of that. The company cited negative brand commentary and underperforming product launches. Lululemon was already down 62% from its highs. It still got punished. That tells you this tape does not discriminate. DocuSign followed the same pattern, smaller in scale. Revenue of $830 million, up 9%, a slight miss against the $841 million consensus. Adjusted EPS of 1.09, crushed estimates of 1.01 by nearly 8%. Free cash flow of $289 million. Record buybacks of $317 million. The stock slipped 4% after hours. A beat on the bottom line, a marginal miss on the top line, and the market says, not enough. Five Below opened down 13%. The discount retailer guided Q2 revenue of $1.18 to $1.2 billion, actually beating the $1.15 billion consensus. Same-store sales expected 7 to 9% versus 4.4%. A strong guide by any standard, but shares had run significantly this year, and with oil at 98 and tariffs expanding, the market questioned whether Five Below can deliver. It sold first. Petco dropped 8% on a similar dynamic. EBITDA guidance below consensus. The pet consumer is not immune. These two names are the canary for the broader discretionary trade. The Dow and Nasdaq divergence tells the rest of the story. Dow futures were up 0.8% this morning, while Nasdaq futures were down 1.3%, a 200-plus basis point spread, the largest since the Iran conflict began in February. Money is rotating out of high-multiple tech into value, healthcare, financials, and energy. It is not a crash. It is a repricing of what you pay for growth when rates are at 4.49% and oil is approaching 100. Three takeaways. 1. The AI trade is not broken. Broadcom and CrowdStrike are not broken, but the valuation air needs to come out. When a sector runs 60 to 200% into earnings, the post-earnings period is a consolidation, not a continuation. 2. Consumer discretionary is cracking. Lululemon cut guidance by over $1. Five Below and Petco got sold on beats. PVH lost 20% for holding guidance steady. The consumer at the margin is under pressure from oil, tariffs, and tightening conditions. 3. Good is not good enough. That is the defining characteristic of this earnings cycle. Beat and raise gets sold if not spectacular. Beat and hold gets destroyed. The margin for error is 0. Lululemon dropped 10% on a quarter that beat top and bottom line. DocuSign slipped 4% on an 8% EPS beat. PVH lost a fifth of its value for holding flat. The question for the rest of the week is whether the selling stabilizes or accelerates into the Friday jobs report. Sienna reports tomorrow morning, the next test. The SPX gamma structure has flipped from positive to neutral or negative, meaning the path of least resistance is lower until buyers step in. I am Daniel Reed. This has been Market Lens.